Madam, what will it take for African countries to unlock their economic potential?
First of all, there is a lot of potential in the African countries. And it would not surprise you coming from the IMF that I would argue that, first of all, it starts with the foundation. And the foundations, in our view, mean good, stable macroeconomic policies that guarantee that inflation is under control, that debt does not grow excessively, and that there is a good policy of raising revenue adequately in order to provide for better access to health, to education, in particular for girls. I would regard that as the fundamentals from which to actually build.
So the focus in Addis is on sustainable development goals.
Mm-hmm.
So how much is required to fulfill those, and where is the money coming from?
You know, for the development of the developing countries of Africa, and particularly the most fragile, the most vulnerable, the most exposed to conflicts, it's going to take their respective efforts, but also the efforts of the international community. So it's going to be a multi-sided approach. And on the first part, the domestic approach, I mentioned the macroeconomics basics. I mentioned revenue mobilization. I would like to add the efficiency of public finance management, the right investments that will be conducive to growth. On the international community, it's also multifaceted. It includes aid, of course, and hopefully there should be no shortage of that, but it also means international cooperation. You talked about domestic revenue mobilization, but to have good revenue mobilization, there has to be international cooperation. And to combat tax evasion, for instance, it takes international cooperation between the various governments, involving also the private sector, so that the corporate world is also aware that it has to participate in the effort of making sure that while being tax intelligent, they also have to be accountable to the territories where they extract resources, for instance, where they exercise activity. So those are just two examples of where the domestic project has to be supported by international cooperation.
So we solicited questions from readers in Africa and around the world on these issues, and several people wanted to know, can African governments in particular raise taxes or demand larger equity in investment ventures, or does that deter investment? Which way, is it a positive or a negative?
You know, I would say that the two critical principles. One is efficiency, and the second one is transparency. Because there is a lot of hidden costs that foreign direct investors are aware of, and that do not necessarily benefit directly the country or the people in the country. So I think that applying the efficiency principle and the transparency principle, even if it is at the cost of raising rates or requiring a certain degree or percentage of equity, I think will be very beneficial for the countries that can attract FDIs, because they will be more business friendly, which doesn't mean to be cozy, but efficient and transparent can actually lead to business friendliness.
So another question we got was, could the IMF or should the IMF champion financial inclusion as a means of financing their own development? For example, Nigeria has many more times mobile phones than bank accounts, and evidence shows that when women have access to saving programs, their incomes rise and their families do better.
Yes, yes is the answer. And we have analyzed financial system and financial systems that are particularly focused at inclusion, at financing all in the country as a key factor for development. You just mentioned Nigeria and the mobile telephones. You could have mentioned Kenya as well, which is a really good example of how mobile telephones, cell phones, have been extremely efficient and extremely conducive to financial inclusion, to the penetration of financial transactions in the entire population, including women. And that has demonstrated its efficiency and its improvement of income of women.
So I wanted to get your view on what role you see for youth in sustainable development.
In most developing countries, there is a very large part of the population that is under 25. And that population is often considered as the demographic dividend of those countries. It's predominantly the case in Africa, but not only in Africa. It can be a demographic dividend if young people have access to education, if that education is actually in tune with the market needs, so that young people can actually, after that, access the market. So we regard public investment in education, and whether it's vocational education, whether it's professional training, that is, in our view, a necessity to actually transform that much talked about demographic dividend into actual, well-being, better being for young people and contribution to the economy of the country.
Our readers also ask about China's role. A lot of discussion about China and Africa. So how have IMF policies been affected by the emergence of China as an alternative source of investment, of development and financing?
Chinese authorities and some China state-owned enterprises have been extremely active in African countries, particularly those that are resource-rich. And financing is so much needed that competition between financial channels is fine, as long as it is applied with the principles of efficiency, not overburdening countries with debt, and certainly not abusing the position of being the financier of a particular project. So Chinese investments are perfectly legitimate if they comply with those principles.
So a lot of our readers also want to know how the problems, the challenges faced by the world economy impact Africa, and how you see that affecting what's going to go, the agenda for Addis, how that affects raising the financing that's needed for SDGs.
Well, the world economic situation is certainly a situation of recovery. Our latest forecast for 2015 shows growth at 3.3%, more than last year. So there is growth. It's clear that there is a slowing down in some of the emerging market economies, including in particular China, which has been a great foreign direct investor, financing force, but also a great partner in trade, which has certainly purchased a lot of commodities. So to the extent that there is a slowdown in China and in other emerging market economies, there is a commodity prices slowdown as well, which is being reflected as we speak. So that is clearly having an impact on the commodity suppliers, and it's one more reason why alternative sources of growth should also be explored by those countries, including in their domestic markets.